This is a Momentum Media production.
The SMSF Adviser Show. Your expert insights into the biggest themes shaping the SMSF advice industry.
Hello and welcome to the SMSF Adviser Show. I'm your host, Keith Ford, joined as always by Aaron Dunn from Smarter SMSF. How are you, Aaron?
Very good, Keith. I'm in Adelaide today, so the BGL RegTech Roadshow rolls on. So this week, Adelaide and Perth, and another really good day with clients and others obviously wanting to get their fill of SMSF and all things technology.
Right, and getting further and further away from Melbourne each week, it seems.
Yeah, but it's not necessarily getting any warmer. Unlike Brisbane and Sydney last week.
That's it. Not moving up the lines of longitude or latitude or whichever one that is.
Yeah, that's right. Well, as is always the case, we kick off our SMSF Adviser Show with what's making news. So I'm going to hand over to you.
Right. So the first thing that we've got for the week, there was some interesting comments from the SMSF Association around ring fencing of super for aged care, with the SMSF Association and Peter Burgess essentially saying that it doesn't support in principle the idea of ring fencing superannuation, and as is kind of to be expected from the SMSF Association and someone who looks after this industry, just looking for as much flexibility for people with how they deal with their retirement as possible, I guess.
Yeah, so there was a paper released, the Financial Sustainability Summit Issues, and there was a range of organisations that ultimately came together to look at, aged care and its role, obviously, in society, and the fact that we've got ageing populations and so forth. And one of those things that the Minister, Stephen Jones, flagged in the conversations that we have to have is what role superannuation could play in that. But quite clearly, some parts of the superannuation industry, and in particular the SMSF Association, have been quite forthright in so far as saying we don't need to be ring fencing some of the superannuation for this purpose. Individuals ultimately will deal with their own individual circumstances around the need for aged care and at what stage in life they may or may not need aged care and so forth. So quite clearly there was an alignment from the minister back into the objective of super, and his views were and have consistently been quite clear that he doesn't intend on superannuation having a purpose for bequests, and therefore we want to make sure that it is being used in retirement, and therefore is there scope for it to be looking at different purposes at end stages of retirement and the potential funding issues, or not pretending, or potential, I should say, but the crisis of funding around aged care and ultimately, the transition of that wealth during their lifetime rather than potentially what would happen after an individual has died. So, yeah, I think there's a lot of water to go under the bridge in this space. Quite clearly, this report has raised some issues that are going to form discussion going forward. But from that point of view, I think the SMSF Association very early on has been quite clear that they don't perceive this as being a good idea to, be stipulating part of your superannuation needs to be put aside for this specific purpose.
Yeah, and I guess it is understandable from the government's perspective, where until they've put together a proper objective of super, it's hard to really do all this legislation that is based on the objective of super. But from their perspective, they're looking at it as, I think Minister Jones said, that a third of the checks that are being written by superannuation funds by value are essentially bequests. And that's not what the system is there for. One of the quotes he said is that the purpose of superannuation is not to have a tax preferred estate planning mechanism. And that seems to be what the government is looking at as trying to fix. And whether ring fencing is the way to go about it is a whole nother question, but that is the idea of what they're trying to get past.
Yeah. And this whole issue of estate planning and bequests and stuff is something that the Morrison government started looking at in the 2017 reform. So this is not new. The challenge is to the government is, if this objective is so important to get enshrined, let's get cracking on it so that it can actually form some policy. Whereas, it does kind of feel like that it's being used for other things without actually getting enshrined, which then, creates the skepticism about what it's trying to do at the moment, in particular when we think of the $3 million and so forth. So it's, what comes first, the chicken or the egg?
Right. A lot of talk about the purpose of superannuation without ever putting it pen to paper.
Yeah. And in reality, I mean, this whole objective has been going on since 2013 when the David Murray, through the Financial Systems Inquiry, made this recommendation. So we're a decade along and we're still talking about it, not actually implementing it. And I think that's where the frustration comes from, because if we do actually get some alignment to this going forward and it is legislated and enshrined, then these conversations become much clearer to have, because these are the guiding principles that take us forward. At the moment, we don't have those guiding principles. So it feels like there is a little bit of policy on the run, and therefore we're trying to have debates, but we don't have any guardrails, and we're just throwing gutter balls all the time, or we're throwing strikes. Probably more gutter balls than strikes, though.
Probably, yes. Maybe the odd spare. But it is that kind of thing where if you have that set of values, then it kind of confines the debate to a single area and makes it a much easier thing to get a handle of. So,
yeah, absolutely.
So our second piece of news to cover for the week, we're looking at financial hardship payments, which essentially the warning from Annie Dawson, who's a technical specialist with Heffron, the warning kind of thing from her was that you need to make sure that if you are sorting out these financial hardship payments, they don't turn into illegal early access, which no one wants.
Yes, this really comes back to understanding process. So there will be circumstances where people will qualify for payments, but there is a process that you need to go through. And the best way we can highlight this is through the COVID pandemic, where the $10,000 early release payments occurred. Now, there are a number of people that took money out, just assuming that they qualified, and they may have qualified because of loss of job or earnings and substantial changes to their circumstances. But it just didn't mean that you could take the money out. There was a process you needed to apply to the ATO, and then the ATO would grant the authority and therefore the release to be able to do so. So I think what Annie is really highlighting here is understanding the procedural aspects as to how you may apply for financial hardship, and therefore what documentation or what process you ultimately need to go through to be able to be entitled to that. And some of it relates to being eligible to receive government income payments for certain periods of time, to be able to then satisfy, the ability to then seek out the payments as a lump sum, again, in a similar vein to what we saw during that COVID period as well.
Yeah. And it's certainly, no one wants to be getting in any trouble for doing the wrong thing. That's something you definitely don't want. But one of the things that I thought was interesting is that it's not the regulator that is making the call on whether you meet the eligibility. It's the trustee. And so you could go through this process and then find out that, they disagree with you about this, and then you get in trouble.
Yeah. And ultimately, like you said, it's the burden of proof is much higher in a regulator perspective, because the trustee and the member are wearing the same hat. So it'd be quite easy to go, oh, do I qualify? And then you put your trustee hat on and, oh, yes, I do qualify. Where in reality, is that actually the case? And the risk then, of course, is that if it is an illegal early access issue, it can not only impact you as a member, where that income will be ordinarily taxed as income rather than potentially as a tax-free payment or a concessionally taxed payment. But the flip side is you as a trustee can also come into problems, because then you have made payments where ultimately you shouldn't have. And as a worst case, the ATO could look to provide directions to you to potentially wind up the fund, or it may be administrative penalties, whatever the case may be. There are actions that could occur that will impact you as the individual, but you as the trustee. So there is a bit of a double whammy there in actually getting this sort of stuff wrong. And therefore, knowing the steps that you need to go through is absolutely paramount.
Right. You get whacked as the member and as the trustee a bit.
Yeah, because ultimately, as the member, you're being paid a benefit that you weren't entitled to. So it's accessible in your hands, not as a concessionally taxed benefit. But as the trustee, then you have trustee responsibilities. And that's part of the privilege of being an SMSF participant, is that you have a dual hat and you need to comply with the responsibilities of running your own superannuation fund.
Right. With great responsibility comes great power, or the other way around.
Yes.
And so the next piece that we're going to talk about is another angle on the $3 million cap. I thought we had kind of exhausted all angles on this particular subject, but we've got a piece from Katie Timms, who is from RSM Australia, talking about the implications of the $3 million super cap when it comes to divorce. Obviously something that has a lot of financial implications just in general, but with the added kind of wrinkle of the $3 million cap and the way that it works could make things interesting, to say the least.
Yeah. So Keith, I'd hate to break the bad news to you, but the $3 million cap, if you thought we've covered it a lot, there's still plenty to go. So
I'm sure there is.
We know that the government's intending on releasing some stuff in the next few months around draft legislation, but this is just another area that we will need to understand the intricacies of how family law splits will impact a member's balance, either the member who is having their balance reduced by virtue of the payment split, and also the member that is having their account balance increased as the non-member spouse. So these are the debits and credits that we're going to ultimately have in the calculation for compliance around what is a net contribution or what is a withdrawal in this earnings calculation. And there's going to be a lot of detail that the draft legislation is going to give us as to what is and what isn't getting included. And we do know, because Treasury has sort of confirmed that, we do need to factor these sorts of things in that calculation. And so what Katie's really highlighted here is one of these other critical issues, and therefore, how do we deal with it in the year that it occurs, which there'll be some relief, but then what happens thereafter? Because once the benefit has been either increased or decreased to the spouse or the non-member spouse, there is potentially then going to be some really important actions that happen thereafter around, do they want to retain that money inside superannuation? Can they take it out? All the things that we've been speaking about for some period of time now, as we wait to see what the real impact of these proposed $3 million measures are going to entail.
And I guess another part is just that uncertainty, because we're still yet to get any solid foundation, any actual legislation, and everyone's kind of making all of these decisions around something that isn't finalized, and need to be cautious of that kind of thing as well.
Yeah. So as much as there is planning in this process with clients about, do you have more than 3 mil? Are you potentially going to be impacted by it by the time we get to the legislation starting in 1 July 2025? There are a range of events that we don't plan for. Someone dying, someone's in a marital breakdown. These are all things that can be unexpected and uncomfortable, but ultimately we're going to come across them as advisors, and therefore we need to be attuned to what the impact of these rules might mean, so that if and when, rather than just if, probably there'll be more whens than if within your client base, that you will be able to deal with these and deal with these appropriately.
Yeah. And I think there was a number in there from Katie that mentioned about 30% of first marriages ending in divorce, and as it gets into subsequent marriages, that number increases. So that
doesn't surprise me, does it?
Well, I guess if you've divorced someone already, you know what the process is. May as well do it again. But I think that is an interesting point, where somewhere in your client base, there's going to be divorces. It's going to happen.
Yep.
The individuals may not want to think about that, but as an advisor, you should be kind of getting yourself across what you need to do in that eventuality.
Yeah. I mean, we're in the risk management business ultimately, right? So part of what we're doing for our clients is not only creating the opportunities, but how we manage the risk around these things. So whether it's risk through marital breakdown, whether it's risk through disability, incapacity, when someone dies and so forth. We spend a lot of time about managing those risks. This is another layer to that management of risk process where there is going to be an additional impost tax. So how we may look to manage that is going to form part of that advice process going forward.
Absolutely. And so we're just going to take a quick break now. When we come back, we're going to have an interview with Shane Brunette from CryptoTaxCalculator and Harrison Dell, who is a tax counsel for CryptoTaxCalculator, as well as being a director of Cadena Legal. We're going to talk all things taxation and compliance considerations when you're investing in crypto through an SMSF. We'll be back. All right, we're joined now by Shane Brunette, who is the CEO and co-founder of CryptoTaxCalculator, as well as Harrison Dell, who is the tax counsel for CryptoTaxCalculator and the director of Cadena Legal. How are you both?
Really good. Thanks for hosting us.
Not a problem, Shane. Not a problem, Harrison. It's great to have you in. I thought before we kind of jump into everything, Shane, Harrison, if you could both give us a little bit of a rundown of your backgrounds and a bit about the company.
Yeah, sure. So Shane here from CryptoTaxCalculator. Founded the company back in 2018, Australian-based service that aims to really make it easy for you to do your crypto tax and all the bookkeeping and management that's involved in that. So it's a software product that essentially allows you to upload all your transaction history from different exchanges and wallets, get that all into a correct format that's appropriate for an accountant and an auditor, specifically with SMSFs, getting you past all the checks and balances that you have there to be compliant with SMSF crypto trust funds.
Well, thanks for having me on as well. And just about me personally and my business separate to CryptoTaxCalculator first, I think that'll color it well. So I'm a tax lawyer, run my own firm, and we primarily do three things, which is crypto tax issues, international tax, and disputes with the ATO. And the crypto tax stuff has really been a focus the last 2 or 3 years. And I work with Shane and the team quite a bit on aligning their product to the actual rules that we need to make it work. This isn't just profit and loss calculations. This is, we've got DGT discounts. We've got all sorts of things that we need to account for, especially with SMSFs. Things get very complicated. And I started my career at the ATO, went through sort of small, mid-sized firms, and been specializing in this area for quite a long time. I like to think I'm pretty good at it at this point.
It's always good to have someone from the ATO or with an ATO background looking over these kind of things.
Agreed.
We can now jump into the, the nitty gritty. Wanted to start with asking you about what key strategies and considerations are essential for individuals and entities that are looking to master the complexities of capital gains tax when navigating through in-specie contributions. And I guess also for those who aren't aware, can you just run through the fundamentals of specie contributions and maybe provide a few examples?
Yeah, of course. Shane, I might go through the high-level stuff first. So foundational stuff, a trustee of an SMSF can only accept contributions if it's in accordance with the SIS Act and regulations, the trustee and the investment strategy. All of those need to be aligned. And one big issue that we see, for instance, is the investment strategy doesn't specifically allow for crypto assets to be contributed in species, which we'll come back to in a moment. So there's a whole bunch of ways to get value into the super fund. The most common way is transferring money, whether it's from employment and your employer is making that contribution, or you're making an additional contribution or salary sacrifice, etc. But the in-species contributions have their own issues because you're putting stuff into the SMSF. And when you're putting stuff into the SMSF, you're disposing of it. So you don't own it anymore. You've got a capital gains tax event. And look, if you've just bought the asset and transferred it in, it's not going to be too complicated what you need to do. But there's been many instances where people have held crypto for quite a long time. They don't want to sell it. They want to keep holding it. And to make their contribution into their super fund in accordance with whatever advice that they have at the time, they want to do it in species. And it's not as simple as it sounds. So shares can be done in species transfers, and it's the same concept in that you're disposing of it. If you bought the crypto asset for $1 and it's worth $100, you've got a $99 capital gain, and those regular CGT consequences will happen for you as an individual. A lot of people are not accounting for their tax, and particularly people who have SMSFs and they want to put crypto in their SMSF, they should be pretty crypto native, I would expect, largely. And a big problem is people aren't putting funds aside for tax, and CryptoTaxCalculator can track all of that as long as you keep things separate. That's right, Shane, isn't it?
Yeah, correct. So in the system, you would essentially have two accounts. So they're quite separate, where you would have your individual, personal trading. And if you do transfer any funds into your SMSF account, it kind of shows up on a separate system there. And you've got the disposal from your one account to the other, essentially.
Yes. And on top of that, there's the contribution caps and all sorts of things which need to be taken into account when they get advice on whether they should even make a contribution at all. And it's good to remember that the value is the market value on the date of the disposal, which CTC will pick up based on data from all sorts of things.
Yeah, correct. So the thing to think about with crypto is that typically there isn't a trusted third-party middleman. If you're trading on one account, there might be a brokerage that has transaction history, but typically that's not in a format that's appropriate for accountants. So there's the issue of transforming that data into something, that's standardized, fiat denominated in a format that's trusted by accountants, that's actually comprehensible, that considers the fees, for example, and the fee might be a third party, like a third currency. So there's a lot of complexities just in that. But then also quite typically in crypto, you might have multiple different accounts, or you might be actually interacting with a wallet directly. And in that case, which is what I call crypto native, you are your own bank, quote unquote. You have access to your own private keys and you have security over your wallet. And in that instance, it becomes really hard to work out what your tax is, because there isn't any third party who's providing you with, like, say, a bank statement equivalent. And so we've actually got to generate that statement looking at the blockchain data. And this blockchain data, it's being built by engineers for computers. It's absolutely not built for accountants to try to interpret and make sense of from a tax perspective. So that's what we do. We're kind of like this layer in between the raw blockchain data and the accountant, where we present everything in this really easy, understandable format. Everything's in the same format. So if you get different clients with different, brokers or different blockchains, different wallets, what you see as an accountant or an auditor is all the exact same type of standard, normalized format, fiat denominated. So it's everything in Aussie dollars, can easily see what adjustments have been made during the reconciliation process, be able to clearly define, separation between, individual versus SMSF entity. Yeah, so basically a crucial resource if you're going to be doing anything in crypto.
The blockchain stuff, distributed ledger, all these big words, and we don't really want to know about it. But what I find the best example for accountants is, while the blockchain is, if you look at the raw data, it's not going to be very comprehensible, or it's going to be very manual. But at its base, it is a perfect example of accounting principles being exhibited. It's debits and credits. And what CTC does over the top is it actually translates it from programmer language into accountant tax language, where we can actually see where the assets are moving and we can account for them. And that's going to be a critical part of SMSFs in general, is you need to know where your assets are. It's very scary if you don't know where your assets are and you don't know where they've been as well, which is going to take us to the sole purpose test. And it needs to be really clean on the sole purpose test stuff.
Right. And I guess on that idea of the sole purpose test, what can individuals and entities do to ensure their compliance with the sole purpose test? And I guess what are some of the potential consequences of non-compliance, of not quite meeting your compliance requirements there?
So the first thing that any SMSF should have is quality advice on this point. But that's we can parrot that as much as we want. What's the actual trip-ups here?
Certainly preaching to the choir on this podcast.
Yeah, I think so. And anything where we tell people to get advice is only going to make the industry even better for all the advisors, including myself. But actually applying it here and starting again with foundationals, the sole purpose test is that SMSFs must be maintained for the sole purpose of providing retirement benefits to members. It's not for providing current day benefits. It's not for other things. So you need to always be referring back to this sole purpose of retirement benefits. And are we doing that? And we mentioned the investment strategy before and the trust deed, and all these things need to be aligned to actually show that the purpose of buying this Bitcoin or Ether or whatever we want to buy is going to pass the sole purpose test, because yes, this is the trustee considers it is for the retirement benefits of the members. And getting an actual financial advisor to assist you with the investment strategy on crypto, I understand, is essentially impossible right now. The trustee can get everything else advised, and they can then firm that up themselves and say, we want to allocate 2% to crypto assets. And that's a pretty common sort of allocation. On the other side, I've got clients that allocate 100% to crypto assets, and that's not something that I could recommend. I don't think any financial advisor could recommend either. But having the basics there of, does the trustee let me do it, is the very first question. And then the investment strategy. And then it can be done. It can be done.
Yeah, I think it would be good to address like this idea of the SMSF industry, accountants, auditors, etc., kind of seeing this as all too hard, like a bucket of like, oh, just don't do it. It's too hard to.
Yeah.
And actually, it's not too hard. You just need the right setup.
And it's like, while it's a new asset class, it's the same old rules and it's the same old questions. And in fact, it's easier once you understand the basis of the blockchain to go, well, these wallets must be SMSF wallets. And one example where I see breaches quite a bit is intermingling of funds. This can happen with bank accounts. So if you have your SMSF bank account and you accidentally transfer 50 grand to your personal one and then transfer it back, you've still had a breach. You've still had a breach of the sole purpose test that you need to rectify. And it's not too problematic to rectify for those inadvertent breaches. But really what accountants and advisors need to do, and they need to charge accordingly for this, is give their clients some guidance on best practices for crypto assets to make sure they don't inadvertently break the rules around sole purpose. There are a few exchanges that are semi-tailored to SMSFs. That world is quite small right now. And most SMSFs are going to keep things on an exchange account. That's simply what most users do, unless they're more what we call degenerate in their behavior and they want to take custody of their private keys and they want to, they want to be their own bank, as Shane was saying. A lot of people, in terms of their retirement funds, don't want to do that. They just want exposure to the asset class. But if they are taking custody, then there needs to be a lot of documentation around this wallet is the SMSFs. And every year going through the transactions and every transfer to another wallet is either owned by the SMSF or is an arm's length third party transaction. And if there is an inadvertent breach, it needs to be rectified. And that's when SMSFs need to be getting specific advice. But they should be getting at least guidance in the beginning so that their auditors and the accountants can be comfortable with how they're going to behave. And if there's a breach, then we have to deal with the breach, just like with any other asset.
Also, something that comes up every now and then is that members of SMSFs or SMSF trustees sometimes find it hard to kind of separate them as an individual from, well, this is my retirement savings. So it's hard to separate those two entities. It sounds like the setup that you've got, Shane, with the individual and the SMSF ones, like you can see them both and they're clearly delineated. It seems like it would be something that would help in terms of the sole purpose test as well.
Yeah, absolutely. I think in the reports that are generated, you can actually see, the transfers to the other entity. So from the individual to the SMSF. And because everything's recorded on the blockchain, you'll be able to pick up if there has been any kind of transfer back to the individual for personal use, etc. And you'd be able to mark those types of questions. An auditor would be able to pick that up. They're also able to see if any of the records have been adjusted. So the history of change. Is this a manually created transaction to kind of cover up for any discrepancies, etc.? This is all available in the audit reports. So there's a whole set of, essentially, we've worked with quite a few different accountants locally in Australia to put together a set of reports that, which the user or the individual client can maintain and generate and work alongside their accountant to just have these all ready to go at the end of the financial year for audit purposes, etc.
Yeah. And it's we kind of go full circle on this one in that if you understand how the assets work to a base degree, it's actually a perfect accounting record. It's easier to track than cash and third party stuff. You've got a full on auditable chain exactly of what's happened. The proof cannot be changed unless someone, is really trying to pull the wool over. It would take a lot of effort doctor reports and things. And that would be quite easy to pick up because it's not going to reconcile. And that's part of what CTC does, is it makes you resolve the errors. It makes you classify whether this other wallet is yours or not. And if it's not, that's fine. If it is, then deal with it. And how you've been transacting, it's just such a perfect record. And it doesn't need to be scary. It's a little bit overwhelming just understanding what these things are. But I spent a lot of time educating advisors on the basics of how this thing works, not about all of the scary news stories and not about all of the other nonsense out there, but just like, how does this asset work and how do we make sure that as professionals, we're advising them accordingly? And when you got those tools, it's very manageable to advise these kinds of clients.
Yeah, to the point before, I think a lot of advisors out there, they might just put this into a too hard bucket of like, crypto, I've seen the news, it's probably not a good idea. It's a lot of grifting in the space. It's just all too risky. Let's just leave it alone. But the reality is it is an interesting asset class. For particular clients, it might make sense to have a diversified strategy that does touch on this asset class to a degree. And really, there are systems in place and software in place that actually makes it super manageable. And particularly like, technologically focused clients, maybe they're in the software or industry. There's a lot of those around these days. But, high net worth clients who want to diversify, it could make a lot of sense to have a discussion with them about, the SMSF strategy and whether crypto should be part of that portfolio. And if that's the case, then, there are the tools out there to get that done.
Yeah, and I guess the way that it operates as an asset class is pretty, distinct from other asset classes. It's not really reliant on the movement of something else as a predictor of the way that it moves. It really is like a very clear difference, and it is very diversified in that sense, I suppose.
And it's quite well established. Like you look at Bitcoin now, it's been around since I think 2009, it's definitely been out there for a while. It's stood the test of time. It hasn't dropped down to zero. It is still in existence. And, a diversified portfolio would suggest that you want uncorrelated assets. And this is particularly something that could go in an interesting direction. So it kind of makes sense. And same with ETH, that's been around for a while now. So there's definitely established assets in this class. It's not like it's just popped up yesterday.
Yeah, sometimes it feels a bit like it has, but it's been around a lot longer than it kind of feels, I guess. But one of the concerns, I guess, that a lot of people have is around security, which obviously is important for all of your assets. But can you go into a little bit about why security of crypto assets is important for tax purposes and how you can kind of achieve that mastery in ownership and crypto security, and including things like, the wallet, the private key aspects? There's a lot to kind of look on here. And I guess you can kind of just touch on some of the best practices for that security.
Yeah, right. Shane, I might jump in with a bit of an overview here. And Shane's the programmer, Shane's the software engineer, and he's going to know a lot of this stuff more than I do. But in terms of practically what people are doing, if you don't know how to take custody of your private keys and manage the security of that, then you shouldn't have custody of those private keys. You should be on exchanges. Those aren't safe either. So a lot of people are forced to learn how to take custody of their private keys. And it can be as simple. I've had clients that have inscribed it on a piece of metal that they hid in their roof. I've had clients that got it tattooed on them. I don't recommend that really. But a lot of people, and very common, is to use something like a ledger or a Trezor, which is a hardware device, which, and Shane, correct me if I'm wrong, but I believe it stores your private key and will only sign off on transactions if you have that hardware wallet actually verify, and approve the transaction, which you need to do physically. You can't do it remotely. And while that offers positives in terms of security, it does make transacting with the accounts a bit harder. However, SMSFs don't need to be transacting, every day. If they're going to have a strategy of buy Bitcoin every day, then that's what it's going to be. And security is still being developed, the best ways to do it. There are still people losing their funds, and it's not like a bank. And this is probably the bit that scares people the most, in that there's no forgot password button. If you get your private key, it's gone. There's stories. There's a guy in the UK who owns 100 million of Bitcoin that he had on a USB, and his mum threw it out. and he's trying to raise money to make the council let him excavate the tip so he can find it. Like, it's silly, the amount of big, scary issues in the space. But there are really simple practices that you can use to get it pretty secure. And this is different to cash in a bank account. You've got, the insurance for ADIs, 250,000 shares are held in custodian structures all through the chest system. But crypto, you can be your own worst enemy. And on exchange, it's just as scary. So you have to take some steps to be secure. Shane, would you add anything to that?
Yeah, I think like the 50-foot view is, what's the difference with crypto is that the transactions, they're not reversible. So it's not like a bank. You say, oh, look, I made a mistake. I need that transaction reversed. You can't do that. You could send an asset to another wallet. That's it. It's done. It's gone. The other big point, like you pointed out, Harrison, there's no forgot your password functionality, really, when it comes to managing your own wallet. There is on an exchange, but then you've taken third-party risk in terms of, who actually has custody over these assets in the case of a bankruptcy. And you've seen that play out in situations like FTX where, the rights of the client who's opened this account are actually quite minimal and they're actually exposed to third-party risk there. So there is a lot to consider when it comes to keeping your assets safe in the cryptocurrency landscape. Having said that, there is a lot of technology out there today to support you during that process. It's not like 2010 where no one knows what they're doing. There's these things called hardware wallets, which are basically a physical device. It's like a physical security key. So you have to be present when you do any transactions, and you can send your assets to this wallet. And so long as you remember your PIN, you should be safe, and you get a couple of backup codes in case you lose it, and you can keep these backup codes in a safe or somewhere secure. Even keep it with the accountant maybe as a third-party trusted person. There's different ways to manage it now, and there's actually a lot of resources out there. There's quite a few resources on CryptoTaxCalculator blogs. You could get advice through Harrison Dell on best practices. This really is part of the practice of saying to your client, look, if you want to set up a crypto SMSF that can handle, taking crypto investments for your retirement savings, here is the package. This is the software. This is the advice to structure it appropriately. These are the things you need to do, including what security best practices are. And if you follow those steps, it's going to be very hard to have any issues. In a lot of cases, it's actually more secure. It's just, you've just got to be a bit more pedantic.
Yeah.
You can't be laissez-faire type of approach. You really have to be particular and making sure that you're just doing it all properly.
Yeah.
There is one alternative to people who don't want to be exposed to third-party risk and don't want to have their own private keys. And this is only emerging recently, where there are retail funds like Monochrome, where they give you exposure to Bitcoin. And this isn't a big unit trust, and there's Bitcoin held in a wallet that they control, but this is a bare trust structure. And, the advisors on this podcast would know bare trust structures quite well from their dealing in residential property and SMSFs. And it's essentially that the fund manager holds the Bitcoin in a secure wallet for you one-to-one, and you can get it redeemed. So you can take custody of that Bitcoin as well. And it's a relatively novel structure. The downside being right now it's only Bitcoin that you can do that with. And there are fees on it. It's not cheap to do that. Whereas holding one Bitcoin, there's no holding costs for that. So there are products coming to market to make it more accessible to SMSFs and institutions and all sorts. But if you're serious about it, nothing's going to beat the real thing, holding it yourself or in your fund. It's your asset, and someone can't take it away from you unless you do something silly.
So don't do something silly, basically.
Don't do something silly, which is great advice. You can apply that anywhere in your life.
Read the instructions.
It's not like a video game where you get the tutorial that you skip through at the start and then hope to figure it out as you go. You accidentally kill the main character and you can't replay the game. No, it's gone. Discuss. So to pivot slightly, I did also want to ask you about some of the hurdles that are associated with maintaining accurate crypto tax records.
Well, as we said a few times, in that the blockchain itself is a perfect accounting record of what's happened. If you've been scammed, if someone's stolen your tokens, it's there. Everyone can see it. One of my public addresses is public so that people can, public to people that I know and think it's me. People can go in and see what stupid trades I've made and dumb assets I've bought and silly internet pictures that I own. And then I have more private ones as well, of course. But again, it's a perfect accounting record, and CTC scrapes that data together and puts it in a way where accountants, auditors, even lawyers can understand it, of all people. And it's just about translating it to traditional concepts and traditional things that we can understand. That's where CTC comes in.
Yeah, really, CryptoTaxCalculator, it takes it from, the too hard bucket to easily done. Essentially, just, plug in your wallet addresses, connect the exchange, the brokerage account that you're using. We'll be able to pull in all the data from all these different integration sources, put it into the one format. We'll highlight if there's any issues with the data. We'll ask the user, the client, the accountant, to reconcile if there is anything that's required, like say an over-the-counter trade, for example, and we weren't sure what that was, or, why are you sending it to this other wallet? What is this other wallet? We'll point that out. And you can kind of work through that system to get to a fully reconciled state, generate the different reports, the crypto tax reports like the capital gains, audit reports, etc. Be able to clearly define who is the owner of these wallets and brokerage accounts, and be able to clearly show, look, this is the client personal account. These are the records for that personal account, and you can see the transfer into the SMSF account. Here are all the records for that SMSF account. Everything's in a very official looking format that's easily consumable for accountants and easily comprehended by auditors, so they can have confidence that they're signing off on something that's appropriate.
I might add to that as well is, and correct me if I'm wrong, but I understand that in the income year just gone, 2023, the ATO is requesting you to tick a box if your SMSF has invested in crypto assets. I understand that's the case. And look, I'm ex-ATO, and what I expect is they're very interested in what's happening in this space because they see a lot of realm for abuse. And as always, the custodians for the system are really the accountants, auditors, and lawyers that allow this to happen. And the ATO is just checking over the shoulder. But accountants and auditors don't need to add that much to their skill set to be able to do this in a way that they're comfortable with. And frankly, can be more accurate than other assets because you've got the raw data that you can look at whenever you want.
Yeah, absolutely. It certainly sounds like having that blockchain, all of the transactions, all it in there, that does kind of sound like an accountant's dream a little bit.
It does. So don't be scared. It's not a nightmare. It's a dream.
So looking at crypto tax software in general, what are some of the key features that I guess can facilitate and assist in managing cryptocurrency taxes effectively?
Yeah, so comprehension of integrations, does it namely support the integrations that you need to manage your SMSF? So the brokerage account and the wallets that you're using. What's the fidelity of that transaction data? So is it pulling in the right level of detail? Not too much, but also not too little. Is it accounting for, in crypto, you can get some really complex situations with, you're buying a cryptocurrency with another cryptocurrency, but you're also paying a fee in a third currency. So can it handle those types of complexities?
Yeah, that does sound pretty complex.
Yeah. It could be a total nightmare, to be honest. And, that's something that the software is meant to handle. How does it work out the market price? Is it in Australian dollars? Is it by the minute? Is it pretty accurate, that Australian dollar price? What's the Forex rate that it's using at the moment? If there isn't a market price, for example, you're trading in an NFT, like there's a transaction with an NFT, does the software highlight these types of issues and ask the client and the accountant to confirm what the correct market price should be? Or does it, in the case of some situations, just drop the NFT out of the transaction history because it doesn't know how to process the data? You definitely don't want the later, right? You want something that points out any discrepancies and highlights this to the accountant and the auditor. The list goes on there, but also with the reporting, are the reports built for Australian tax office? Do they consider the capital gains correctly? Especially from, the transfer of individual to the SMSF, the long-term capital gains. What's the inventory methods that are being allowed for here? Does it integrate with other, downstream software providers like Xero, etc.? The other thing is for auditors, like they have very specific requirements when it comes to auditing reports. We spend a lot of time on our auditor report trying to create a lot of transparency about what's being done in the system. And that's really invaluable for these auditors. That's where a lot of time is spent making sure that everything is correct and getting the auditor comfortable enough to be able to sign off on this year's activity. And so that's a really big focus as well for selecting a crypto tax solution.
Yeah, and I guess with the SMSF structure being pretty uniquely Australian, it's probably adds an extra level there of interacting with everything.
Well, like yes and no, because like definitely super funds have to deal with the extra level of superannuation legislation on top of tax law. But it's the same sorts of issues that we're seeing in US arrangements and all over the world in retirement funds and pension funds. You've got not as strict restrictions generally as Australia's superannuation law, but there are extra rules to follow. And we can basically give assurance to the level of the data being supplied to the software and then giving that to the auditors, accountants, that it can really be applied to any kind of fund, whether it's a super fund or whether it's a trust or whether it's a company, individual. Often clients that have self-managed super funds that have crypto will definitely be doing stuff themselves. In my experience, at least.
Okay. And if any of the listeners have any questions and would like to get a bit more information, where can they find you guys?
So accountants, advisors, or clients, they can find me on my firm website, which is www.cadenalegal.com.au. I'm also pretty easy to find on social media, including LinkedIn. I'm pretty open to having a quick discussion or taking on a client, whatever it may be. I'm very committed to the education side of it. So if you've got questions, please reach out.
Yeah, and CryptoTaxCalculator, that's CryptoTaxCalculator.io. We've got a lot of information on our website as well. You can also reach out to support for a demo of the product. We could give you a free trial so you could get comfortable with the software, get familiar. We could coach your way through it, get you in contact with Harris and Dell there for any advisory work. Really just give you the complete package so that you can go out and market yourself to different clients who are interested in diversifying into crypto as part of their SMSF strategy. So it's CryptoTaxCalculator.io. If you just plug it into Google, should be the first thing that pops up.
Brilliant. Well, I think that's everything we had for you today. Shane Harrison, thank you very much for coming on the show.
Thanks so much for hosting. Really appreciate it.
Yeah, thanks for having me.
And we're back now, joined now again by Aaron Dunn to wrap up the week. Aaron, what was the most interesting thing for you this week?
I think the discussion around aged care and the interplay that it has with superannuation is naturally a conversation that we need to have. But I think, we don't really want to be seeing governments forcing their hand upon, dipping into this ever-growing superannuation pool for these, predefining a lot of these purposes. And I think to the SMSF Association's credit, they went out on this very early and have said, we don't support that view. Quite clearly, the government's sort of stewing on a whole range of things in this topic of superannuation. As we spoke about earlier, I would like to see this objective, legislating the objective, get locked away. And then it does actually give us a really strong foundation to have many conversations about a lot of these things. But at this point in time, a lot of those conversations really don't have the structure without the foundation being laid. And I think to me, that's the most important piece, is that there's an opportunity to get this legislating of the objective of super done so that we actually have a foundation laid. It then allows us to have a more open and honest conversation about many of these issues that are going to become more front and center because of the baby boomers, not only into retirement, but obviously thinking about the succession and wealth transfer that's going to be occurring over the next 10, 20 and 30 years.
Yeah, absolutely. I think that point on just getting the objective of super nailed down and figuring out what it's going to be, obviously that's going to cause quite a large national debate, I would have to think. A lot of people have a lot of interest in this. A lot of lobbyists will have a lot of interest in this, and a lot of conversation will go on around it. And, maybe it's something that because there's one going on with the voice referendum, perhaps they're wanting to wait and have a separate conversation afterwards instead of all of these things coming to head at the same time. I certainly would prefer if they just get it done, but maybe that's the thinking is, only one national conversation at once.
Yeah. I mean, I don't think it's going to need to be to the extent that we're seeing with, the decisions on the voice and so forth. But the reality is we need something in place to have a conversation about this. And the reality is nothing's perfect from day one, but actually having something to shape conversation going forward is important, and then allow it to evolve. Legislation's going to evolve, circumstances are going to evolve. But if we've got something there, like I said, this has been talked about since 2013. Here we are in 2023, and we've seen multiple governments that have tried to do it, and the arguments are around aspiration and a whole range of things. But we can't have decent conversations about where we want to head. There's no point building a house if you don't have a foundation.
Yep. Got to get that base level first.
Yeah. Yeah. And therefore the frustration of people with superannuation change is all linked to the fact that we don't have a foundation that actually enables us to move forward. Yes, we've got a sole purpose test. We've got other things that sit within the superannuation laws, but this is not what it's about. It's about actually setting up an aspirational process for us to look at and have conversations about what superannuation is and is for as we move forward, and things like aged care and whether it's for bequests or not for bequests, and whether you should be drawing out income in retirement, and all these things can't have that debate until you have your foundation laid.
Absolutely. And so we'll finish up. I'll just give a quick reminder to everyone. SMSF Adviser Technical Strategy Day. You can get your tickets 17th of October in Sydney, 18th October in Brisbane, 25th of October in Melbourne. Keep an eye out for those. And Aaron being the MC, as we mention every week.
Yes. Yeah, absolutely. Looking forward to it. So Keith, as is always the way, if anyone has any suggestions around topics and speakers, how can they get in contact with us?
That's it. At editor@smsfadvisoronline.com.au to hit us up with anything you want us to talk about.
Excellent. Well, thank you once again for joining us in this week's edition of the SMSF Adviser Show. Have a great rest of the week, and we'll see you next week. Bye for now.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.